Good morning. August 6th. Pretty amazing. We were heading in a right direction, or the right direction for rates. Not so much this morning. Hard to really say exactly why. Overnight data, not huge, but generally bond friendly. Oil prices are stable. While there's the conflict in Iran continues to be conflicted, more positive speak out of the White House in terms of a deal. Oil up about a point, nothing crazy. Certainly, the one troubling data point hit this morning. Challenger layoffs missed only 33,000. Not a great number for bonds, and potentially an indicator of what tomorrow's non-farm might look like. We've got claims here in a minute. A couple straight weeks under 200,000. 3 straight weeks is going to make me suspicious, I've got to tell you. Nice rally in MBS these last 5 days and up and really into the close yesterday. We got right around a par handle on 5.5s. I have to tell you, we took some coverage yesterday afternoon. Locks were a little bit slower for us. Good morning, Bob. Than they were the prior 2 days. So I'm really worried that folks were taking on some risk. Although, again, I don't mind that risk into Friday, sort of a day-by-day thing. Right now, we're in a position, pending this data here, which just hit. Looks like first move might be green. No, 199. So, okay. Continuing claims higher than expected. Revised down. Net still worse. We're back above 1,800. Jobless claims under 200 again. 199, but revised up 1,000 last week. So net, I call that even. Here's one thing that I kind of like, if you will. Labor costs. Last month, 1.8, revised to 1.3, expected 2.1, came in at 1.3. In a lot of ways, almost really the opposite of ADP, which had a weak headline number but some tight wages. I would say that the onshore data as a whole, I'm going to call neutral. If you wanted to say that it was slightly bond unfriendly, I don't know that I could present a tremendous argument against that. I think if you pull in some of the data overnight, in particular the EU data, I would say that maybe slightly bond friendly. When we look at the markets, what we see is Asia, generally speaking, down. Europe, generally speaking, up. Futures here onshore mixed. Nasdaq, Russell showing indicating negative. Dow, S&P indicating positive. VIX up about a point to 16. Bitcoin up. And in terms of commodities, most commodities up. Silver and natural gas down, but you're talking only about 1%. Dollar mixed, but mostly stronger. If we look at the yield curve, worse by 2 basis points, pretty much across the board. Yesterday, now this was a disappointing data point yesterday, albeit mixed, and this really calls into question tomorrow's report, which might be all that matters. Hey, Steve, if we post a bad number, but for those of you that missed ISM, business activity up month over month to 59. 50 is equilibrium. New orders up to 57 from 55. Prices up to 70 from 67. Don't love that. Headline up from 54 to 54.1, but worse than expected. Bond friendly. Despite the components largely bond unfriendly. Now, here's the million-dollar question. ISM services employment went from 51.2 to 47.7. That's job loss, right? Under 50 is contraction. It's starting to get complicated, right? In that, what happens if tomorrow prints, and I'm just going to make up some numbers here, not a prediction, right? We're expecting 80,000, unemployment rate of 4.2, you know, earnings of 0.3, earnings come in at 0.5, jobs are flat, unemployment rate goes to 4.1 because of some anomaly. How do we react to that, right? Are we, and what's going to be our focus? Are we going to care about headline? I'm going to tell you this. I'm going to care more about wages than the headline. I'm going to certainly hope that we don't have an outlier headline. I'm struggling a little bit with how we're going to print a better number than last month, 57 up to 80. I would almost say the more likely outcome is that the 57 is revised up to 80 and the 80 comes in at 57 than it is that the 57 stays 57 and we print an 80. I would say by and large, all of the data except, and I'll put a pin in the except for a second, is pointing to a bad non-farm number. The except are these claims. Now, this particular claim number doesn't help or hurt us because it's largely in August. Maybe not largely, but it's yeah, actually no, it's not. Yeah, the last couple of claims numbers are gonna struggle to get you to a terrible non-farm. I think that the question is where is ADP and ISM and some of our other feeder reports? Where are they disconnected from claims and then potentially therefore non-farm? So that's some of the risk that you take if you float into tomorrow morning. What do rate sheets look like today? So if I look 5 coupon, call it 10 o'clock strike. I mean, that's probably when most desks are striking. You're about even, okay? Maybe we're a tick worse. What you've lost is the 5-6 ticks in run that we had going into the close. So I want to be clear about this. For those of you that aren't looking live or live-ish, if you're indicating down on the day, which we are, that's a little wonky, right? We are down on the day, that's true, but we're not necessarily down relative to your day, i.e. rate sheets. Because we rallied into the close, and I don't know if there were a lot of reprices because there wasn't enough rally to merit a reprice, right? 5.5 coupon, probably a little bit worse than printed rate sheets, maybe 2 ticks. They got as good as 6-7 ticks better into the close. 6 coupon, depending on when you struck, again, maybe 1 tick. So what's interesting about this, and again, for my cap markets folks, you know, what you do is different than my originator folks. When rate sheets drop today, okay, what you had was a free look at this morning, unless we get worse, right? You had a free look at this morning. There was lost opportunity into the close yesterday, but you're not going to get hurt. And so that changes the way I look at these numbers. So yesterday afternoon, full disclosure, we took a bunch of coverage, okay? The way I saw it and the way we had the ability, and for my cap markets folks, I'd love to get some feedback from you. I don't know, not knowing who's live. I know a lot of people, by 100 to 1 watch this on replay. But what we looked at yesterday, and we had that opportunity. I wasn't willing to take risk into this morning because of the rally, not necessarily because of this morning. Soon as we saw 100 handle on 5.5s, that makes sense to me. The closer we got to a 102 handle on 6s, that made a heck of a lot of sense to me. So, we quite a bit. One, two, and throughout yesterday, I think we covered 4 or 5 coupons, even down to some arm coverage, which is wonky at best, by the way, down to a 4 coupon because we had enough of a run, 100 basis points, whatever, made a lot of sense. So, here's what I would say. If rate sheets print within a tick plus or minus of rate sheets yesterday, I'm kind of back to locking 6.25 note rate, 6.25 to 6.75. I think 6.5 is a 50-50 proposition. I think we've been languishing around these levels, so whatever. I think 5.5, if we printed at the close yesterday, would be almost 100% locked for me. But because we've pulled back, it's a trickier decision to make. And I think when your loan is funding and when you started floating it should be the driver of your decision. If I look at a 1 month chart, if you took on that floater last couple of days of July, I think you're crazy not to lock. And you're closing in the next week or so, I think you're crazy not to lock it. I think you're crazy to take risk into tomorrow. If you took the floater on, middle of July, it really is a conversation with your borrower. I mean, let's put it this way. In the last month, if I look at July 6th, so I do a full 30-day, we are a little bit more than a half a point worse on 5.5s, right? But we got to over a point worse, so you're mid-board. So it really depends on where you picked it up. July 13th, if you've been floating a loan since July 13th, you've taken on a tremendous amount of risk. You've probably sweated out a couple of nights. And by the way, you're essentially at that level. And you might be better than that level, because if you were going to lock 30, 45, 60 days back on July 13th, but now you're going to lock 15, 30, whatever, 21 days, net, you might actually be doing better. So, and it does look like 5.5s may have tightened here a little bit. It's hard for me to make a case right now. If rate sheets print right where we are this moment, which will be in line with yesterday, knowing that we printed a third consecutive week of sub 200 claims, you've got to be worried about non-farm tomorrow. There's just no other way to say it. 5 coupon is a little bit wonkier. I think, there's I'm maybe 20% less, convicted about that. But if you took on a floater July 31st, if you took on a floater maybe even July 30th, you're crazy to not lock that loan today. You've got a great story to tell. Pricing is better. You're talking 5.25 to 5.75 ish, give or take, depending on product and what, not everybody, how rate sheets are pricing into a 19 or a 69 strip or whatever. At the end of the day, I just don't love this claims number. It gives me pause for tomorrow. And the question is, do you want to gamble? And in my experience, bulls and bears make money and pigs get slaughtered, as you know, I sort of say on repeat. So there you have it. For those of you watching on replay today, make a best efforts attempt to join us tomorrow morning at 8:28. Let's do a live reaction, maybe even get some predictions for non-farm. I think it's an important one, but I don't think it's super duper duper important in that we don't have a Fed meeting in August. So it's interesting it'll be interesting to see how the market trades it, because to some extent you've got to discount it a little bit because the Fed's going to get another jobs report before. And even if this is a negative, I think in both directions we can't overreact to this number, but we probably will. So there you have it. Thanks for joining and watching on replay. I'll see you guys tomorrow.